Now, the beauty of spreadsheets, again, we've talked about this before, is that we can do some sensitivity analysis, or we can use what's called what if techniques that say, well, what if this occurs and what if that occurs? So we'll have with our original budgets, we'll plug in some kind of what if analysis, and we might come up with some modified assumptions. And even if we're confident that the modifications need to be applied, then we'll come up with revised budgets. We have what's referred to as a flexible budget. And the difference between, well, flexible budget, we haven't even talked about a static budget. What we come up with, we could first refer to that as a static budget. We'll come up with the total dollar amounts and it is what it is. Flexible budget means that we're not really going to budget an absolute dollar amount at the end. We're simply going to base it upon volumes, okay? And this is actually a more fair way, a fair way of determining whether or not you have a variance or not. Now, for a service company, we'll look at the good news is that there's no merchandise inventory, so it's actually going to be an easier budget. We'll come up with the sales budget, we'll come up with the operating expenses budget and the budgeted income statement in the same financial budgets. So the service company is going to be very similar, except we don't have to worry about inventories for raw materials or finished goods because there's no inventories. We simply just budget what it is. So a picture of what it would look like is a little simpler, where you just have your sales budget, operating expense budget, budgeted income statement, but you still have your financial budgets. Those are all the same. There's no difference. Now for a merchandising budget, it's still a little simpler than what we've already come up with. But we're not so worried about production in the context of direct labor and direct materials, because we buy, or manufacturing overhead, we buy our products. It comes as a finished product, so we buy and sell. Instead, we're going to go ahead and prepare the cost of goods, inventory and purchases budget. We've done that already as well. So this is kind of a picture of what a merchandising budget would look like, where you have a sales, cost of goods sold, inventory and purchase budget, operating expense budget, budgeted income statement, and then the same that we have for both the manufacturer and a service company, the financial budgets. So taking a look at the cost of goods sold, inventory and purchase budget, this will be a little bit simpler, but the cost of goods sold is the inventory we plan to sell during the period at cost. The desired inventory, we're going to add that. It's going to have the flavor for what we had to do for direct materials and also for the finished goods. But we just do it once now because it's just one inventory element. So cost of goods sold plus the desired inventory gives us the total inventory needed, less the beginning inventory, and that's what's going to give us what we need to purchase. So let's go through an example of a merchandiser budget. One Circle J convenience store expects sales of $500,000 in January and $520,000 in February, $530,000 in March, and $550,000 in April. Management sets prices to achieve a 40% gross profit. As a result, cost of goods sold is 60% of sales revenue. Management wishes to have ending inventory equal to 10% of the next month's cost of goods sold. So this is pretty similar to what we learned before, so we'll need to pay attention. This is a little different, but it's actually a little bit simpler. So we come up with our cost of good inventory and purchase budget. Our budgeted sales are 500, 520, 530. That was given in the previous slide. The cost of goods sold, 300,000, is computed how? Well, if our gross profit is 40%, if our gross profit is going to be 40%, the cost of goods sold is going to be 60% of revenue. So we're going to budget 60% of 500,000. 60% of 500,000 is going to give us 300,000. The desired ending inventory, they told us that's going to be 10% of the next month's cost of goods sold. Without going through the computation of the next month's cost of goods sold, well, it looks like it was 312,000, but we haven't gotten there, but when we do, we would get that. Then that 10%, well, okay, since we're here, 312,000 is 60% of 520, right? 60% of the sales. And then to get the desired inventory, well, we want 10% of that to be in inventory, so that's 31,200. We'll get our total inventory required. We're going to add these two, and then we're going to subtract our beginning inventory, and that was based upon our projection of cost of goods sold, 10% of the following months, which is 10% of the 30,000 is 30 or 300,000, so that's 30,000. Total inventory required less the beginning inventory gives us the amount of inventory to purchase, $301,200. And we just kind of flow through. Now, when we're going to put the income statement together, we're going to be focused on the sales and the cost of goods sold. We're also going to be focused on, for the balance sheet, we're going to have our ending inventory amounts. Remember, this is 31,200, and we want that at the end of the month of January. Okay, the impact of credit and debit card sales on budgeting. Credit card companies charge an interchange fee. Credit card company and bank pay the merchant purchase amount less the transaction fee. So debit card transaction fees are usually lower than the credit card transaction fees. Generally speaking, if you have like a MasterCard is at 2%. So whatever you sell at, you're going to lose 2%. Now, the reason why we'll still go ahead and, even though we have to pay those fees, we'll accept it is because it's for the convenience of the customer. Not everybody carries around cash. In fact, people are carrying around less and less cash. So for the convenience, we just may not have a choice. The clients demand it, so that's why we have to do it. And so it is what it is. Retailers often have their own credit cards as well. It allows for easier purchase. In fact, many of you, your very first credit card might be a retailer's credit card. As an example, Target, Kohl's, or Old Navy. Usually their credit requirements are a little lower than other areas. But it's like a revolving account, so you can pay it usually in full within a month or even over an extended period of time. There's a graphical representation of comparisons of the different types of credit cards, third-party credit cards, retail credit cards. Take some time to read through that, and that'll give you kind of a feel for what those differences are. And so that completes chapter 9.